In this lecture, we will understand um, how to calculate the cost of debt. As discussed earlier, that there are three main components of capital. The one is debt, the second one is preferred stock, and the third one is equity. It is possible that you can use cost of debt in short term as KD and cost of preferred stock as KP. But this is not necessary that the similar term will be used by all the textbook, whatever you are using. So whenever you are using a short term, you should be very careful, and you can check your own book that what symbol they are using. So it is possible that they are using different term, that there is no issue. You can use the term whatever defined in your book, or uh, whoever is teaching you, if you're using a different term, that you can use that one, but the concept will remain same. When we say cost of debt, it means that the loan that is bringing by the firm in capital. And when we are discussing preferred stock and equity, so similar terms might be used. Like in cost of equity, some textbook use KS rather than KE. So there is no issue, you can use the similar term. In this lecture, we will discuss the cost of debt, that you can say as KD. Just assume that uh, firm offered a bond and currently its price is 900. Now the coupon rate is 10%. Maturity time is 5 years. So now the question is asking you to calculate cost of debt. I bring this question over here just for your fundamental understanding, that whenever you are using a bond in your uh, capital structure as long-term debt, you should be very careful that the coupon rate which is given in the question cannot be taken as cost of debt, because this is the rate which will be paid by the firm to the bondholders who received some years back this bond. But right now, the main rate of interest which will be important for you to understand is the investor required return, which is prevailing right now in the market. So whenever this kind of question is given, it means that the price is not at par value. Sometime it might be at premium, and sometime it might be at discount. Right now, as you can see, that this bond is offering at discount. So in a bond valuation chapter, we understand it that in such a situation, we have to calculate investor required return, which in other words is also called as yield to maturity. So can we take coupon rate as cost of debt? No, you should be very careful that of course, we can take this provided that a bond currently is offering at a par value. Since the value is lower than the uh, par value, then uh, this coupon rate cannot be taken as a cost of debt. In such a situation, we are interested to calculate investor required return. And student, when we say investor required return, it means that we will be interested to calculate YTM. It is possible that you have learned it on Excel or a spreadsheet or on financial calculator, that how to calculate investor required return or YTM. Over here, I am giving you a simple formula that through trial and error, you can use this formula. And if you calculate this YTM, then this YTM can be taken as investor required return. So as you can see that if you have all the other informations and you fill it, and then by using the trial and error method, you can find out YTM. YTM is only possible when uh, left hand side of the equation is equal to right hand side. If this is not equal, it means that you need to try more and more rate to find the investor required return. Since this is somehow quite tedious to find investor required return like this, so another shortcut method that might be used, and you are already quite familiar, that you can use this kind of uh, method. Of course, it's not necessary that it will give you a correct answer, but it can give you a closure approach that you can take. I would prefer that if you use a spreadsheet or Excel or financial calculator, there you can find out the exact investor required return. If you are interested to apply this one, then you can see that C stands for coupon payment that is received by the company, by the investor. Face value of the bond will be here, present value or the price of the bond, and T is the time of the maturity. In the denominator, you are finding the similar two informations, the face value as well as the current price, and you will divide by 2. So you can use the shortcut method to find out investor required return. Suppose this was the data which is given in question, that the price was 900, coupon rate was 10%, and maturity time is 9. If I fill all the information over here, that coupon payment will be taken as 10% on the face value, and that will be 100. Face value was 1000, and the current price is 900, divided by the maturity time, and finally you will divide by the sum of these two and divide by 2. So the result is 12.63. Reminding you again that this 12.63 is an approximation of actual yield to maturity. If you have other sources, like if you can apply financial calculator, or even if you can use Excel to calculate the YTM, that can give you much better idea of investor required return compared to this shortcut method. This shortcut method or approximation method might be used when you don't have other sources. Then you can apply this one to find out cost of debt. Suppose loan taken from the financial institution, and its amount is 100,000. The rate of interest is 12%, and the tax rate is 40%. In simple terms, if I say that if I'm taking a loan of 100,000 and the rate of interest is 12%, it means that I will pay 12% of this on this loan of 100,000. But when I'll pay 12%, uh, in financial accounting point of view, this would be taken as a deduction from the income statement as interest expense. So interest expense is a tax deductible expense, and if you are using it, it means that you will be able to get some advantage in terms of tax. Since there is a certain advantage in tax rate whenever you are paying this interest expense, so the cost of debt that we generally use in our calculation in finance, we take cost of debt after deduction of tax rate. So this will be our general practice, that whenever these two information are given in question, the rate of interest as well as the tax rate. So first, you will take the interest rate which is given in the question, or cost of debt that is given, and then you will minus the uh, tax rate from this one. Since right now the tax rate is 40%, so when you will deduct from this one, your actual cost of debt will be 7.2%. This tax rate that you are deducting from the cost of debt is also taken as tax shield. That since you are providing this interest to bondholders, you will be able to pay less taxes. It means that you are saving some tax from your overall financial interest payment.